Hey, this is Big G, and or Big or Gene or Gino or however you know me. Um, this is going to be lesson number 16 on how to place orders. And I'll just say from the get-go, this may be the longest one I've done so far, and it may be the most confusing or most difficult to understand. I know that even sometimes in my own case, I have to stop and think about how I'm placing orders. Usually it's not that big a deal just because of the way I trade, but this can be a little complicated, so you may have to watch this video a few times or just learn how to do it as you start learning how to trade on your own. And also, let me say that depending on the brokerage firm that you use and depending on the software, their order tickets and order forms and all that are going to look a little different than what I show you today. But it's all basically the same thing. So just let me show you where we're at. We're at lesson 16, how to place orders. We're over halfway through with my planned videos. As you can see, I've got several more to do after this one, but just kind of giving you an idea of where we're at, and there's still plenty to learn. And as I look back at what I've done in the past, I probably will add some more specifically regarding trading strategies and maybe more candlestick pattern stuff. But anyway, this is where we're at. And can you hear the neighbor cutting the grass, the lawnmower? Sorry about that. Anyway, so here we are, lesson 16, how to place orders. So the first thing you need to know about buying and selling a stock is there's this thing called the bid and the ask price. So you need to understand the bid-ask prices first of all. And the bid price is the current price that you would pay to sell a stock. The ask price, or the offer, some call it, is the current price that you would pay to buy the stock. And the spread is the difference between the bid and the ask prices. So let me show you. This is Apple on TD Ameritrade. And you see Apple, of course, the symbol up here. The closing price was $167.78, and then the bid ask. The bid is $168.17, and the ask is $168.18. Now this is a little confusing because I'm recording this on a Saturday, and so it's actually Good Friday was yesterday. So Thursday, Good Friday, the market was closed. So on Thursday, Apple closed at 167.78, and you need to know there's aftermarket trading. So in the aftermarket trading, it went up a little bit to 168.17, 168.18. So that's why the bid ask is a little different than this price. During the day, when the market's moving and active, the bid ask is going to be, or the current price is going to be somewhere between or right at the bid ask. So I know that's a little confusing, but basically the bid price, this is what, the ask price is what you would pay to buy Apple, $168.18, and then the bid price is what you would expect to get if you sold Apple, $168.17. Now, of course, I understand that during the market hours, these numbers are constantly changing. But that's the difference in the bid ask. The ask is what you would pay to buy it. The bid is what you would get to sell it. So let me give you an example here. So suppose the price of Apple is $167.78, like we just saw, and the bid price is $167.75, and the ask price is $167.78. So the spread is 3 cents, or the difference is 3 cents. So if you purchased Apple, you would pay the ask price of $167.78. And if you just immediately turned around and sold it, assuming the price hasn't changed, and if you immediately turn around and sold it, you would get the bid price of $167.75. Therefore, you would lose 3 cents due to the spread. So you just need to be aware of that. Now, in the case of Apple, the bid price, or the bid ask price, is very tight, just a penny off. If I were to go to Bank of America, for example, Bank of America, the bid ask price is 8 cents off, $30 ask, $29.92 on the bid. If I were to go to Fred's, my favorite store, but not my favorite stock, you see the bid ask is 13 cents off. You'd pay $3.13. If you turn around and sold it, you'd only get $3. There's a 13-cent spread. So you need to understand the bid ask price before we get into how to place orders and all that good stuff. So that's the bid ask. Now, how do you place an order? Well, let's look at an order ticket on TD Ameritrade. So let's go back to the TD Ameritrade page here, and we're back on Apple. You see the price, and of course they make it really easy for you. There's just a green buy button and a red sell button. And so if you want to buy Apple, we're going to click buy and see how this order ticket pops up. And so you've got buy here, quantity, we'll just buy one. And then you've got the stock symbol here. And then you have order type, and you've got limit, market, stop limit, trailing stop, percentage, trailing stop, dollar. We're going to talk about all of these in this video. So in this case, it pops up limit as the default, and then notice that the price that comes up automatically is the ask price, $168.18. And then time in force. Do you want this order to just be for the day? You can do for the day plus extended hours. The extended hours is the aftermarket trading I mentioned earlier. The market is open from 9:30 in the morning to 4 in the afternoon, but you can trade in the pre-market starting at I think 8 o'clock in the morning, and the market goes from 4 o'clock to 5 or 5:36. I'm honestly not sure what time it actually closes in the aftermarket, but there is pre-market and aftermarket trading, and those are called the extended hours. And I believe you have to have permission from your broker to do that. I've done it a little bit, but not on a regular basis. But anyway, so it could be a day trade including extended hours. GTC means good till canceled, which means you would place this trade and it would be good for days and days, weeks and weeks, actually months and months. I think they give you like a 6-month time frame to do that. And then GTC would be, it would work for the days ahead, weeks ahead, even during the extended hours, GTC plus extended hours. So that's what an order ticket looks like, at least on TD Ameritrade's website. So let's go back to our slides. We took a look at the order ticket. Now let's talk about those different types of orders. So you had the market order. A market order fills the price fills your order at the current market price. So when you buy, the buy price is the ask, and when you sell, the sell price is the bid, just like we looked at a minute ago. So a market order guarantees execution, but it does not guarantee price. In other words, if you just know you want to buy Apple and you place a market order to buy Apple, you're going to buy Apple, but you're going to buy Apple at the current market price. So you don't determine the price, but you do determine that you're going to get in and get it. So a market order guarantees that the order will be executed, but it doesn't guarantee the price. And again, it goes right back to this is the scenario here. You buy at the bid, you buy at the ask, you would sell at the bid. And so you would just buy a market order and it sells or makes that purchase for you at the current market price. A limit order is a little bit different, and most traders use limit orders, and you'll see why in a minute. A limit order fills at the price that you determine. You would buy at or below the current price, and you would sell above the current price. A limit order guarantees price, but it doesn't guarantee execution. In other words, if you place a limit order, you determine how much you want to pay for it or how much you want to buy or sell. You determine that price, but you're not guaranteed that it's going to happen. You're not guaranteed that it's going to be executed. Let me give you a couple examples, and then we'll go back and look at how to do that on TD Ameritrade. So a limit buy order, for example, suppose the price of Apple is $167.78 and you want to buy it when it dips down to $165. Maybe you've done your technical analysis and you think, I think it's going to drop back down to $165. I don't want to buy it at $167.78. So you would place a limit order to buy Apple at $165. Okay, your order will be filled when it hits $165 or lower. If, for example, Apple gaps down overnight to say $164.50, your order would be filled and you would only pay $164.50. So you'd even get it cheaper than you wanted to get it in this case. So with a limit order, you determine how much you're willing to pay, and then that controls your risk even more. So for example, if we're looking at an Apple chart, and again, I'm not suggesting you buy Apple today, but if you, for whatever reason, decided you wanted to buy it down here around 165, if it goes down to 165 or lower, you're in. Your order goes through. But if it never goes to 165 and it stays above 165, your order is just going to stay there. It's not going to go through. But a limit order helps you determine price, or you determine the price. All right. A limit sell order. Let's look at this example. Suppose the price of Apple is at that 167.78 where it is today. You buy it for 167.50 and you want to sell it when it goes up to 177.50. So you could place a limit sell order for 177.50 and that'll trigger if Apple's price reaches 177.50. This is helpful when you can't or you don't want to monitor your trade. In other words, maybe you've done your technical analysis, you've placed your order to buy Apple at 167.50, and you think based on your analysis of the chart, you think it's going to go up to 177.50. So you just place an order that says, okay, when it hits 177.50, sell. You don't have to monitor your screen. You can be at work, you can be in a meeting, you can be out playing or whatever, and that order is going to kick in for you automatically when it hits your target. And you might say, well, why would I do that? Well, again, based on technical analysis that you're learning with the charts, maybe you see that in this case, Apple is going to hit resistance at a certain level. In the scenario I gave the example, I said 177.50. In this case, it may be right around that, actually a little bit higher. But maybe just looking at your technical analysis, you think, I think Apple's going to pop up, and I'm going to sell it when it gets up here to that resistance line. So these are just examples to give you an idea how to place the orders. So let's look at TD Ameritrade again and look at that order ticket. Okay, and let's say we're going to buy Apple. Hit the buy button. We're going to buy one share, and you're going to do a limit order 168.18. Let's say you want to buy it at what did we say, 167.50 or something like that. I forgot what the example said, but you go to you type buy one share of Apple, limit order at 167.50, and let's say you want that to not just be for the day, but for the day today and the days ahead. And you would place a good till cancel order. It's good until July the 31st. Today is March 31st, by the way. So it gives you 6 months. Was that? No, 4 months. So you got your order. Buy one Apple limit at 167.50. So it's not going to trigger until the price goes to 167.50. So this may or may not work depending on Apple's price. If it keeps going up, you're not going to get it here. It's good till cancel. You hit review. It says buy one share of Apple at 167.50. It's going to cost you 167. That does not include commission fees. We'll talk about those later. And then you would just hit place order here. All right, so I'm not going to place this order, so I'm going to hit do not place to get us back out of here. And that would be how you buy a share of Apple. Now let's say you have Apple, or you bought it and you want to sell it. Then you would hit the sell button. It automatically pops up sell one Apple. There's a symbol limit. Let's say you want to sell it at 177.50, like the example we talked about. That's your target. You want to change this from day to good till cancel, so that way it's going to be up and running for the few days. And so you've bought it, say, what was it, 167.50? We were going to buy it, and then we're going to sell it when it hits 177.50. Hit review. And so you're going to sell 1 share of Apple, limit at 177.50, estimated total 177.50. Okay. So again, you'd hit place order here. I don't want to place the order, so I'm hitting do not place and backing out of this. So that is market orders and limit orders. Now, the most important order probably is a stop order, because a stop order protects your trading account. A stop order helps you to manage your risk. It eases your anxiety. You know before you place the trade, or at least you should know before you place the trade, how much you're willing to lose. And so after you buy, you should immediately place a stop order on the stock that you buy, so that you can manage your risk and protect your money. That's the biggest thing, is protecting the money that you have and managing your risk. Okay. And with a stop order, your sell price is always going to be below the current price. So let me give you an example. So a stop order example, suppose the price of Apple is at that 167.78, and your limit order to buy Apple at 165 is triggered. So you got it, you bought it. Now you want to sell Apple if the price goes down to 160, therefore risking $5 per share. So you would place a sell stop at 160, and if Apple falls to $160, your order will trigger and you'll lose $5 per share. Okay, and we're going to talk in future videos about how to determine how many shares to buy and how much risk to take. So if you're wondering about, well, how many shares should I buy, we'll talk about, there's a formula that I'm going to give you on how to do that. But in this case, you're risking, or willing to risk, $5 per share. So if you buy 1 share, obviously you lose $5. If you buy 10 shares, you're going to lose $50, and so on. If you buy 20 shares, you're going to lose $100. So you're willing to lose $5 a share based on the math that I will show you in the future. You're willing to lose $5 a share. But how would you place this order? Okay, so let's go back to the order thing. Let's assume that you have purchased Apple, and you would, to set your stop order, you would hit sell. And of course it pops up, and let's say you just bought 1 share, and then under order type you're going to hit stop market or stop limit. Okay, we'll talk about the difference in these two in just a second, but if you do stop market, you would type the activation price, and in this case we said it would be 160. Okay, we're going to change it to good till canceled. Be careful with that, because they defaulted at day, and sometimes if you don't remember to change it to good till canceled, you'll think that your order's good to go for tomorrow and the days ahead, when it's deactivated after the end of the day. So always be sure you do a good till cancel order, unless you just absolutely want it to be just for that day. So you've got a sell order, sell that 1 share of Apple at stop market at the price of 160. So the activation price is 160. We're going to review the order, and it says you're going to sell 1 share at stop market price 160, and so you're good to go. All right, and again, I'm not going to place it because I don't want to. I'm going to hit do not place here, but you would hit place order if you want that to go through. Now, what's the difference in stop market orders and stop limit orders? Good question. A stop market order will trigger when the stock price hits your order price, but depending on market conditions, you may not get the exact price. A stop limit order may trigger when your stock price hits your order price, depending on the market conditions. A stop limit sets the minimum price you want to sell. Okay, this can be a little confusing, but basically, when you have your stop and you place that activation price, if it's a stop market order, then when it hits the trigger price or the activation price on the TD Ameritrade ticket, it says activation price. When it hits that price, your order is automatically turned into a market order. And remember, market orders are based on the current price, okay? When you do a stop limit and your activation price is hit or price is triggered, your stop order becomes a limit order. And in this case, you're saying that I want to sell this, this stock at this minimum price you want to sell, okay? So let's go to the chart of Apple, and let's say you know, you buy here at 165-ish, or was it, I forget now what we said, 167 or whatever it was. You would buy here, and let's say, let's just pick a day on the chart. Get a little marker up here running so you can see what I'm looking at. Let's go back here to this day, back in November, and right here, and see where the closing price was down here, and it gapped down the next day to here. And let's say you had your stop order placed somewhere in the middle, right here. Well, if you had a stop market order, it's going to sell the next morning immediately at the opening price. So it's going to sell for less than what you had intended for it to sell. Because it became a market order, it's going to sell at whatever the market price is the next morning. So you're going to lose a little bit more than you had intended to. If it's a stop limit order, and this is where it gets kind of confusing, if you have a stop limit order where you're saying, I want to sell this stock at this price, this is the minimum price I want to sell it for, if it gaps down below your stop limit order, that order is not going to trigger, and you're going to continue to hold that share, those shares of stock of Apple. And so your stop limit order would not be triggered in the case of a gap. Your stop market order would be triggered in the case of a gap. And again, this is where maybe it gets kind of confusing. So let's go back to the slides and just look at it one more time. Remember, market order is the current market price. Limit order is the price that you determine. So when you have a stop order, and it's a stop market order, it's going to turn into a market order when your price is triggered. If you've got that stop limit order, it's going to turn into a limit order when that price is triggered. However, it may or may not go through. The market order will definitely go through, but it may not be the exact price that you want. The safe bet is to always do a stop market order, because if the price is going down for whatever reason, you want to get out. If it goes below your target stop, then that goes against your trade. It goes against what you thought was going to happen as you looked at the charts, and you just want to get out. And so it may cost you a little bit more than, say, $5 in our example earlier, than what you planned. But you just want to get out of it because you'd rather get out of it than get into something that tumbles way down. Like, for example, back to the Apple chart, maybe you had, I'm trying to find a little gap here where it tumbled. Maybe you had a stop somewhere, not much of a gap here, but anyway, I think you get the point. If you want to get out up here instead of letting it tumble down here. That's the point. So a stop market order just gets you out of the trade. It gets you away from something like this happening, and you're just ready to trade again. You take your loss and you move on. There's one other type of stop order, and that's called a trailing stop. And these can be done manually or automatically. A trailing stop is simply adjusting your stop order as the price moves up. So if you go back to the Apple chart, and let's say you buy down here somewhere, and you had your original stop down here, and the price is going up, and as it goes up, you're going to move your stop from here to, say, right around here. And the price keeps going up, you're going to move your stop up here. That way you're guaranteeing profits, because you bought down here As it moves up, you're making money. You place your stop here, so you get out. If the price goes back down, it keeps going up. You move your stop here, it keeps going up. Maybe you put your stop right here. So it's called a trailing stop, where you just move your stop order up as the price continues to go up. And then, of course, eventually, say you put your stop here after this candle, and then, of course, you get out when it goes below the stop. So a trailing stop is just a stop order that you move up and adjust as the price is moving up. And you can do this, as it says on the slide here, you can do this automatically. What I do here? Well, anyway. Oh, well, come on. Messing things up now. What happened? There we go. Sorry about that. Technical difficulties. So go back to the trailing stop. So you hit the sell order. You'd put your whatever amount of shares you've got there, and then you would hit a trailing stop percent or trailing stop dollar. In this case, you would just put the stop parameter, put the amount or the price that you want to stop at, and go from there. Say 165 or whatever the number is. Review your order. Just get to cancel. Review your order, and it says a trailing stop with the stop parameter 165 points. Or you can do the trailing stop percent, where you can just put a percentage. Say if it's 5% below the current price, or 1%, or whatever you want to do, you can do it by percent. I've never done this before, and you can probably tell because I'm stumbling through this part. I do trailing stops usually at night if I have a swing trade, and I look at my position, and then I'll adjust my stop usually after hours, and that's what most people do. So that is stop orders, and get my slides back up. That's trailing stops. Okay, so like I said, this one is a little bit longer and maybe a little more confusing because there are just so many different types of orders. But hopefully this helps you a little bit. And of course, if you have any questions, you can let me know. Otherwise, that's lesson 16, and I will look forward to seeing you next time. Thanks.